was selling real estate limited partnerships to deposit customers of the bank, retirees, investments that are highly risky. You always hear the stories about the used car salesman type of person who goes in and tries to sell you something you don't need, and that just doesn't work. I went in and started working on trust accounts, learning the investment business that way. So I cut my teeth very quickly. Trust is the number one getting clients in the investment business. If you're trying to sell somebody every time you see, it's just not going to work. Approach it more from a personal relationship standpoint, and I think your chances of success are much higher.
Everybody, welcome back to the Flow Syndicate podcast. We have another episode for you today. We have Jim Iglewski from Courier Capital, president of the firm. How are you?
Hey, Nick, good to be here.
Yeah, this is fun. I'm excited to talk more about, your background and especially in the financial services industry. I've been fortunate to have a lot of mentors and people in my life who are in that industry. So I have a good understanding, but I think for my audience and myself, we can learn a lot today.
Yeah,
so
sure.
this will
Happy
be
to
great.
help.
Yeah.
Thanks for asking me.
Yeah. So tell me a little bit, so your background, how did you get into financial services?
So I always knew I wanted to be a banker or in the investment business from, the time I was very small. And right out of college, I got a job with a securities firm that was sort of a startup owned by one of the savings banks here in Buffalo called Gold Dome. And I was selling real estate limited partnerships to deposit customers of the bank, which, looking back on it now seems a little odd because these are, very risky investments that I was being asked to call on bank depositors who were retirees and make a $5,000 investment in this speculative thing. But it was what people were doing back in the late 80s and 90s. So that's kind of how I got my feet wet in the investment world. And I liked it and just decided to continue on in that space. So I got actually my first job was a telemarketing job, and that kind of gave me some experience on the phone so that I could call these people up and ask them for their investments. And from there, it just progressed. I got a job in a local bank, Marine Midland Bank, which is now HSBC. I got a job as a commercial real estate lender in that company, and one day we had a presentation from our private bank group that came in and talked about what private banking is, trying to get some referrals from us in the commercial real estate area. And I was really intrigued with the presentation that the woman gave, and I went to her afterward and I said, I'm really interested to learn more about what portfolio management's all about. And she got me an interview, not a job interview, but a conversation with her boss. And he said, well, we'll call you sometime if anything opens up. Well, 2 weeks later, a job opened up for me. And
good timing.
I was 30 years old. I didn't really know anything. And I went in and started working on trust accounts and learning the investment business that way. So I cut my teeth very quickly, which is, I think, a great way to learn. And, from there, I just progressed in the private banking world for most of my career until, really recently when I joined Courier, which is a registered investment advisor, which is a little different.
Mm-hmm. So you mentioned, around 30, that's when that opened up for you. How is, from your experience, business development and trying to get clients in financial services? Do you think it's similar to other industries, or since you're investing people's money, it's, you maybe have to go about approaching it differently because people's livelihoods are pretty much in your hand from a financial standpoint? Yeah,
I mean, trust is the number one factor, I think, in getting clients in the investment business. And the way you get trust really is through a personal relationship with your clients. You just have to click with them. And, you always hear the stories about the used car salesman type of person who goes in and tries to sell you something you don't need, and that just doesn't work. And I've been through so many sales training programs throughout my career that looking back on it now, I think, they just don't work all that well. The things like the assumed close and In our business, what you really need to show is competence, and you need to give the client comfort that you're going to do the right thing for them. And that takes a little bit of time. So if you're trying to sell somebody every time you see them, it's just not going to work. So, approach it more from a personal relationship standpoint, and I think your chances of success are much higher.
Yeah, so back in college, I had an internship at Mass Mutual, and it didn't happen much there, but I not mention names of companies, but other groups out there, I noticed their tactics for insurance specifically was very pushy. And that was always something that turned me off, right from the get-go. Like, as you mentioned, it's really about, building relationships, having that comfort, and then eventually when the conversation, comes about, that's an opportunity for you to try and get that business.
Yeah.
But what have you seen lately in the industry that you think has been the same over the past, 2 decades? Or have you seen anything else where it's like, the industry, whether it's consolidation through banks or any new things that are coming up that is different or things you haven't seen in the past?
Well, I think what has remained the same, I think, in all the years I've been in the business, and certainly before that, is making sure that you understand exactly what the client's needs are. That's the most important thing. If you get a prospect or a client who tells you they are risk averse, they do not want to have investments that are highly volatile, they don't want to lose money, there's nothing you can say or do that's going to change that mentality for them. And I think sometimes because you can get paid more in this business with certain types of investments that are a little riskier because the fees are higher, there's a tendency sometimes to push clients in that direction. It almost never works in my mind. I always told clients from the day I started in this business, really the most important thing is that you can sleep at night as a client and you feel good about what I'm doing, and I'm going to tell you what I'm doing and make sure that you're okay with that. So that has remained the same, and I think will always remain the same. And that kind of gets back to that level of trust that you build with those clients. What's changed over the years is just the amount of choices you have as an advisor in terms of what you use to put in clients' accounts. Between, when I started, it was predominantly stocks and bonds and some mutual funds. Now the mutual funds have proliferated and exchange-traded funds have exploded. So now you have all kinds of options to put in a client's account. So at Courier, one of the things we're very focused on is fee sensitivity. We don't want clients to overpay, I guess, for things that they can get relatively cheaply. So we tend to use more exchange-traded funds than we do mutual funds because it's just generally less expensive, particularly if it's a passive kind of investment, not active. So that's probably the biggest change. It's just the number of different solutions we have as advisors to use for our clients, and I would guess that's going to continue.
No, that was going to lead me, what you just said, to my next question about fees. Some people might say, well, why don't I just, the S&P is usually outperformed. Why don't I just invest in, a low-cost index fund versus these mutual funds? And that's the question I have for you. Do you think that for whatever reason, some of these companies are not being, upfront about the fee structures, and then when the clients see they're getting whacked for this, they're like, shouldn't that have been brought up from the start? Are you seeing any of that from?
Yeah, I think the providers of the funds and the ETFs by law are pretty transparent with what they charge. You have the prospectus, you have fund fact sheets, they show expense ratios, things like that. What's not always quite as transparent with certain advisors is what are they charging for their services on top of that. Warren Buffett, I think, had good advice for the average investor. Look for some low-cost index funds, allocate a little bit across some of the different asset classes, although he's pretty concentrated himself, but he can take on that risk. It's probably a good strategy for the average investor, but I always say to our clients, if you give up active management, like in an active mutual fund or active ETF or stock picking, for example, you're giving up a potential source of return. You get returns from 3 ways: your strategic asset allocation, which is 60% stock, 40% bond; tactical asset allocation, which is, okay, I think the stock market's a little overvalued right now, so I'm going to go down to 55% stock and raise my bond allocation. And the third way is security selection or manager selection. And if you give that up by going all passive, you're giving up that potential source of return. However, it is true that passive investments have outperformed active for most of the past 30 years, and that's largely because of what we're seeing right now. The Magnificent Seven stocks are dominating the S&P
Right.
500 returns. So you see that experience on the way up, but you also experience it on the way down like we saw in 2022. So if you had an actively managed portfolio in 2022, you likely outperformed the S&P 500. But that's just 1 year out of many where, passive investments have outperformed active.
Yeah, and I think too right now, just times are very interesting because there's a lot of volatility in the market. So could you look at that though and say, if you, instead of a buy and hold guy, if you are a trader, do you think based on this market and how it is right now that there's a lot of opportunity, but you got to be on the right side of the curve?
Yeah, there's always opportunity, and you really have to pay attention very closely. A good example is, NVIDIA, which is the baby right now that everybody loves, right?
Yep.
It's done really, really well over the last couple of years. It reports earnings tomorrow. The market is anticipating that, and so if you're a trader, you want to get ahead of whichever side you think that's going to happen. So if you think that NVIDIA is going to have really strong earnings, you get ahead of that today because you're going to miss it pretty quickly, and vice versa. If you think it's going to be, they went from 250% growth to 112%, and the stock got creamed for it, even though they're still growing at 112%.
At a significant
so
amount.
It's crazy, which is why we don't trade. I mean, we don't believe you can win at that game unless you're, you're really intent and focused on just a few different securities. We're long-term investors, and we invest for the, kind of the ups and downs of these companies. We just want to invest in good companies that we have really good feelings about, not only what they make, what they do, who they serve, their revenue growth, all of those things, but just good, solid companies.
Yeah, I mean, like the hedge fund industry, for example, there's probably only a couple winners who have outperformed the S&P. I mean, overwhelmingly, I don't know if you know the percentage, but how many of them do not meet the benchmarks?
Well, hedge funds are unique. I mean, when you use the term hedge fund, it's kind of like saying mutual fund because there's so many different types of hedge fund strategies out there. And I always tell my partners when we start talking about the markets right now, where they are, kind of all-time highs, we haven't had a good hedge fund blow up in a long time. So to me, there's something that means something that there's something around the corner. This last correction we had, which was based on very specific things happening in Japan, really wasn't enough to cause that. But these strategies that are highly risky, short stocks, or do all kinds of different currency trading and things like that, those are risky. And generally speaking, if you're with the good ones, they do pretty well over the long term. But again, you don't really have that transparency and don't really know what you're investing in a lot of times.
Yep, and so
It's all faith in the manager themselves.
So that's why knowing the sponsor and the track record of that sponsor is really important.
Critical.
I even remember back in the day, like, with real estate syndications and what people are still doing now is versus the fund model where they're not raising money blind pool. They'll just try and find a deal and, they'll put all their assumptions in and say, here's our preferred return, what we're going to try and hit. But it's like garbage in, garbage out. I mean, how long have you been in the industry? Who do you have on your team who has provided, consistent returns? And I'm sure for your company, you guys got founded, or you were founded in 1967.
Yep.
That's a long time. So let's talk about the start at Courier and then up to the size of your company now. What was that process like?
So
to build?
I've only been with the company a couple of years, but I've learned a lot about them. They were started by a gentleman named Howard Babcock back in 1967. He eventually took on a couple of more partners. The long-term partner that was there was Frank Leonard, who I think most people in Buffalo who know Courier kind of associate Frank's name with the firm. And it grew throughout the 70s and 80s. And then, over the course of time, just started adding a few more advisors over time and really became a firm that depended heavily on referrals from existing clients. And so Courier Capital has never really advertised or done much marketing. We've got our building on Delaware Avenue with the sign in front, which is probably our best piece of advertising because people say, oh, yeah, I know, I've heard of Courier Capital.
Yeah. It's small city.
Yeah. And then over the years, Courier just grew through the advisor base, and in 2016 was purchased by Five Star Bank. Many of the banks looked to buy registered investment advisors and back then insurance companies as well because of the fee income. And then in 2018, I think it was, bought another firm called Rob Shaw and Julian, and then a firm out of Rochester, HNP Capital. So we've grown through acquisition over the course of the last 8 or 10 years. We are looking for more acquisitions to make or advisors to bring on. We've got 24 people currently on our staff in Rochester, Buffalo, Jamestown, and Pittsburgh. Hopefully opening office soon in Sarasota. And we just continue to grow through referral, but you'll start seeing us marketing a little more too, because doing things like this, I think, is important too. You get a younger generation who I think is better suited to the digital experience than maybe reading an ad in a Business First or something like that. But we do still use Business First and rely on that as a partner to market ourselves. So we'll continue to do that. And we're hoping to grow. We're $3 billion, which makes us one of the largest RIAs in Western New York. And we're looking to grow that to $4 or $5 billion by 2030.
So how does so an RIA, how is that different than others in the financial services industry?
Yeah, so you have multiple different options. A registered investment advisor carries with it the highest standard of care from a fiduciary perspective, similar to a trust bank. And what that means is that for clients at all times, 24 hours a day, 7 days a week, their investment portfolio has to be reflective of their current situation. Unlike the broker-dealer world where it's more of a suitability standard at the time of sale. So if I sell a client, if I'm an advisor and I sell a client a mutual fund or an annuity or something like that, it has to be suitable at the time of sale. But, 2 years from now, they could still own that and it may not be suitable, but there's that less fiduciary standard. So that's why you see a lot of brokerage advisors, and I'm not bad-mouthing them at all. There's a lot of very good ones and successful ones in town that do operate under that, larger, I call it a capital F fiduciary. But you'll see a lot of advisors who have thousands of clients. And I always wondered, how do you service thousands of clients like that? Well, part of it is, they put them in a program and they let it go, and they don't have to constantly rebalance it or look at it. Whereas
it's very transactional based,
It can be transactional. A lot of advisors are going to a fee-based business now, so that's different from the old commission structure. And that's partly because clients want that. They don't want to see churning in their accounts. They don't want, to see capital gains in their accounts.
Yeah, I see that.
So, so anyway, we operate in that highest fiduciary standard of care as a registered investment advisor.
And $3 billion, you said, for your company.
Almost $3 billion.
Almost $3 billion. What's that process like to raise, that amount of capital? Because for Western New York, that is that's a pretty solid number, especially for here.
Well, you'd be surprised at the pockets of wealth in Western New York that still are here. Legacy wealth from decades ago, centuries ago, in some cases. We've got clients from families that, were, owned homes here on Delaware Avenue back in the 1880s. And then there's an entrepreneurial spirit here happening too, which is really exciting. We're seeing, for the first time in 30 years that I've been in the business, we're really seeing wealth being created by entrepreneurs here in town, in more discrete businesses that you wouldn't even know about. And I think that's really interesting. And then, of course, you've got what's happened over the last 5 years or so, just this explosion of buyouts. Larger firms coming in, buying smaller firms, and the owners cashing out. And I think that's going to continue to happen for the next 5 years at least, as long as the economy stays relatively healthy and valuations don't get absurd. They did start getting a little top heavy in the last year or two, but I think larger companies, that for them to grow, the best way to do it oftentimes is to go out and buy another firm, and similar to what we're looking to do. So I think you'll continue to see that. So there is wealth here. You just have to kind of know where to find it.
Yeah, well, with acquisitions, I think you can only grow organically for so long, it gets to the point that if you have investors or resources, whether debt, equity, that probably makes sense for the time that you're spending to try to grow your business, that an acquisition makes sense, assuming that that target company, is not overvalued, right? That you're getting it for a good price. And do you also look to, like, for acquisitions to grow the company, does geography matter, where the companies are located, or would you still look elsewhere if the numbers made sense?
I would say within the region, it doesn't matter. We're not looking to buy, a firm down in Philadelphia or New York City or anything like that. I think if we were looking to buy a firm, we would want it to be within our geographic area, which I would say for Courier is probably in that Syracuse to Buffalo down to Pittsburgh area. And then once we establish ourselves in Sarasota, in that area as well. So it doesn't really make a lot of sense for us to start looking beyond that. There's plenty of opportunity here. There are a lot of advisors in town here who are nearing the end of their career and who are looking for
An exit.
that escape or that exit. And so we are open to talking to anybody willing to talk and see if we can't help transition them in a way that's good for them. And we have talked to a few already, but these things take time. It's really hard if you've built up a firm, your own firm, hard to kind of let go. And
Oh, I get that.
and in a lot of cases too, they're trying to bring in children to run the business, but that doesn't always work. So I think there will be opportunity for us.
So you think then that the industry is fragmented enough still where there is opportunities for consolidation?
Yeah, I think Courier Capital has always prided ourselves on being an investment advisor first. So you hear all these firms that call themselves wealth management, and they try to do a little of everything for everybody. We do wealth management, we do planning, and we're good at it. But the investment advisory part of our business is really number one, whereas some firms, the wealth management piece of it is number one. Started by a financial planner, perhaps, who doesn't really have a lot of investment experience, and so they use outside investment sub-advisors, or they use Vanguard or Schwab or Fidelity, whatever platform they're on for custodian purposes. So there are synergies there if we can find a firm that maybe isn't quite as investment savvy, but that's really, really good on the financial planning side, where we can bring them in and really offer them our services on the investment advisory side.
Okay. Do you think for some of your clients, do you offer as well opportunities that are not there for, let's say, the average investor? So are there any accredited investors where, let's say, there's private placements, or if there's real estate opportunities, are you able to facilitate some of that for your clients?
Yeah. Over the last couple of years, we've spent a lot of time trying to build up an alternatives platform, which includes private equity, private credit, real estate. And so we've developed a relationship with a firm that does due diligence on all these types of offerings and provides us with ideas. So and we've implemented them in a number of client accounts, and these are accredited investors for the most part. And it's new for us, and a lot of our older clients aren't really interested in that, but a lot of the newer clients, those entrepreneurs I talked about, certainly are. And one of the reasons we're looking to open this office in Sarasota is because of the tremendous wealth down there. You meet a person, and they'll say, well, I've got my advisor who does my stock and bond portfolio, and I'm happy with them. But what I really am looking for are some really unique alternative solutions. Venture capital, private equity, private real estate. And so that has really prompted us to even expand on that platform more. And so, yes, we have that as an offering. I've even been involved in some of the local angel and venture capital groups that are around town and have brought some ideas to my clients. In those cases, they're not really official investments of Courier. I'm just making a connection for them because we maybe won't do the due diligence on a startup firm or any one of the 43 North type firms, but we'll make a connection for them, and we'll try to figure out, we'll give them some guidance as to how to go through the process for them to do their own due diligence. These are sophisticated investors I'm talking about who really do this regularly.
Right, right. Politics aside, but really just from a policy standpoint and what you guys are seeing at Courier, interest rates being where they are, some people might argue that Powell did not do a cut soon enough. Are there things, even geopolitical risks, that you guys are factoring in, and are you seeing a positive outlook for the U.S. market, or are you taking more of a conservative approach and wait and see based on all this uncertainty that's going on in the world right now?
Good question. We have an investment committee that meets weekly, really. We have a bigger meeting that happens monthly, but we talk about a number of things in those meetings, from individual stock positions to putting mutual funds or ETFs on or off our platform or what have you. But the big conversation is always on the macro, talking about what's going on in the world and where we think things should be. We've been overweight equities for the last 3 years after COVID. Got heavily overweight back in 2021. And we've remained there. We've kind of felt that the economy is fairly strong, despite what we're seeing right now with some weakening in the economy, and with interest rates, going up as high as they did. They're around historical norms right now, so we don't think we're really too high on the interest rate side. I think Powell and the Fed did wait too long to hike. I think their transitory story, and we were saying it at the time, was incorrect. And that was just looking at the supply-demand issues. The supply chain issues were going to take years to work out, which has been the case. So, they look in the rearview mirror. They look at past economic data. They don't really use forecast data too much, and that has hurt them. And I think it's also hurting them right now on the way down. I mean, I think they're too restrictive. I think they should have cut rates in July. But, that's only a quarter point is what they're going to cut. And, whether it's July or September, probably in the long run doesn't really matter. But we're clearly in a downtrend on interest rates, which is a positive for the economy. We seem to be in a little bit of an uptrend on the unemployment picture, which is a negative. So some equilibrium there will play itself out, I would think, before the election or shortly thereafter. We'll kind of know what is the real strength of the economy based on the unemployment rate. And we don't see it falling off a cliff. We don't predict a recession. So we think equities probably will continue to do okay for the rest of the year. You're going to have these pockets of sell-offs like we had the previous 2 weeks. A lot of that is program and algorithmic trading, so that if a number comes out that's bad, like CPI or unemployment, there's just a ton of trading going on that's eventually, kind of works itself out and the market settles. You mentioned earlier the markets, being volatile. Actually, the markets have not been overly volatile when you look at the VIX, which is what we look at. The VIX
isn't that like the Wall Street's preferred?
Yeah, it's kind of a measure of where you think volatility is going to be over the next 30 days. So if a VIX is 15, you can have 15% upside or downside in the next 30 days. But if it goes up into the 30s and 40s, the market is predicting a highly volatile negative market, probably. So it got up, I think, into the 30s 2 weeks ago or so ago, and then now it's back down to 15. So
it came right back down.
It came right back down. It's been at a low level. It seems like the market's volatile when you have the Dow up or down 500 points, but in today's terms, that's not really a big move. Not historically anyway. So we're positive equities. We're still overweight. We've been underweight. This is where the tactical asset allocation comes in. We've been underweight on the large cap growth side. We've been a little wrong on that one, but that is a valuation call. We just think some of these tech stocks are certainly overvalued. But we've been overweight on the large cap value side, which are the less expensive stocks, and they seem to now be pulling out, and the rotation is now moving from large cap growth to value a bit. And again, that's why our clients may not see all that upside when you have a really strong Magnificent Seven, but they certainly won't see the downside. And again, for most of our clients that tend to be older clients, they're not looking to hit grand slams or home runs. They're just looking to
want to preserve their
hit
capital
singles and doubles. Right?
Yep. But for a young person who wants to open up, an investment account, they got a lot of time. So I don't know what your thoughts would be on that, but they can afford to be pretty risky. And I'm sure if they loaded up on tech stocks, they'd be pretty happy
This is a huge problem with the younger generation now, particularly if you're working and you're in your, let's say, early 30s. You remember the financial crisis. And you probably remember your parents worrying about it. And it was a big deal, right? Stocks are down 40%, 50%.
Yep.
I know people who happened to retire in 2008, right before that hit. So a lot of younger people right now are too conservative, like in their 401k plans. And all I would ask you to do is go back and look up compounding and compounding interest. And they call it the eighth wonder of the world, and it really is. If you're contributing to a 401k plan every 2 weeks in your paycheck, and the market goes down 25%, and you're 30 years old, you should be happy about that because you're buying now at 30%, lower prices. You're buying on sale, and that will rebound over time, and that will compound. And as soon as I increased my allocation percentage to I think 15% on my 401k, and I started making more money. And luckily, I was with a company at the time that did a 401k match. The power of compounding all of that was tremendous, and I could have never saved that on my own. And I tell my kids who are of working age now, put as much away as you can, and they'll always say, "Well, I just can't afford it." I say you can't afford
missing out on the opportunity.
Because even though you might be 30 years old or 35 years old and retirement seems so far away, there is nothing else for you. I mean, my parents' generation had pension plans. There aren't pension plans in most places anymore. So you're saving for yourself, and you have no idea what Social Security is going to be. And it's nowhere near enough to live on even today. So it won't be 25, 30 years from now. So my advice, max out as much as you can, be as aggressive as you can, and you will reap the awards down the road.
The biggest, issue that I have is I just don't think financial literacy is being taught in schools.
It's not.
And I think that should be mandatory. I mean, I think even as early as a 7th, 8th grade class and then on to high school. And I got my own theories on that, but, why do you think that is? It's so simple to just even get the basics right, like a simple course on, 101 of personal financial literacy.
They used to teach home economics, which I don't know if they still do, but it had nothing to do with economics.
Yeah, shocking. Yeah,
they should teach personal finance. I think in your senior year in high school, I think what's happening, this is my own personal opinion, but what's happening with college nowadays is atrocious, really. I mean, you get a financial aid package to the college you want to go to that you've got accepted at, and part of that is student loans. And they plug that number in, and the student is okay with it because they want to go there. The parents are okay with it because they figure, well, I don't have to start paying this off for a long time, or maybe I'm not going to pay it off at all. My student will have to pay it off. But when that bill starts coming, it's big, and it's 9-10% interest rates. I mean, it's not cheap.
Not at all.
And so people who are 35, 40 years old are still paying off their student loans today. And I'm not saying you shouldn't get a student loan, but I'm just saying that the more government help you get with tuition, the higher tuition goes. I mean, it's a reality. The more you subsidize something, the higher the price gets over time. As a senior in high school, if you understand this, if you can look at a quick balance sheet of your situation and understand income versus expenses and the cost of credit, those kind of things, I think you're going to be much better off. Why they don't teach it, I really don't know. But we're doing a disservice. Maybe it's because there's just so many other subjects they need to teach nowadays. But I think I do think it's an important subject and something they should spend a lot more time and effort on.
Well, I think with artificial intelligence and all the stuff that's coming out, it's just information is so instantaneous now that I don't even know how the universities can keep up. I think like new stuff is changed like every 6 months, even sooner now. It's like, okay, that's an old model. And 6 months later, we have a whole new thing that's working. And 6 months ago, what we were teaching is just not even in effect anymore.
Right. No, I agree with that. And that's probably squeezed out other things that maybe we once thought were important. And who knows, maybe they'll start squeezing out more of the liberal arts kind of courses, which I think is a big mistake because I'm a big believer in a liberal arts education and,
Oh, me too. Yeah.
reading the, philosophy and, things that are totally unrelated maybe to what you want to do in life. But my son's in college still, so I tell him all the time, pick a course for your electives that you're interested in that's maybe not related to the field you're pursuing, just to round out your brain and get a little smarter, right? And I don't think that's a bad thing. But unfortunately, I think some of those things are starting to get squeezed out because there are these other topics that are becoming more important, I guess.
But even as we know around here, a lot of these small schools, they're getting killed.
Yeah.
They're getting absolutely killed, and which is fine. But the other schools with public funding, I mean, they're making out great. But it's like we just got these great institutions. Me, who went to one, it's difficult to see how you kind of get out of that hole, and it takes real leadership to do that. But I just don't know how you come back from some of that now. These small schools are getting crushed.
Yeah, enrollment's a big problem, and it's again because costs are just really high. And but I'm a state college grad. I went to Buff State, and I turned out pretty good, and that was a perfect school for me. And
Yeah.
I'm involved with Buff State, but this isn't necessarily an endorsement of them. But you don't always have to go to the big Division I school out of state. Let's put it that way. Just there's plenty of good colleges and universities locally that, and the SUNY system is really a gift to our community. Two of my daughters got through the SUNY system, and they both ended up with good careers and no student loans, or at least not a lot. So
That's helpful. That's very, very helpful. Yeah. Oh, I want to get back to what you talked about, with Courier and the firm and the growth. The big thing for me is, being a young person, I mean, I took a different path. I wanted to start my own company, jump into entrepreneurship right away. But for somebody who maybe doesn't want to take that full path, but they don't want to be a traditional employee per se either, they could go into a financial services firm and have the infrastructure of, a credible firm, but then yet they're kind of working within it and generating their own business like an entrepreneur.
yeah.
So, typical financial advisor in most places. So what would be some advice, looking back on your career and the successful things that you've done and accomplished? What could you tell a young guy or girl who says, I'm really interested in the financial services space. I know it's difficult. A lot of people burn out right away because not many succeed. But if you're like the 10% that make out the first 5 years, what does it really take, work ethic, et cetera, to get there?
Well, it takes a lot of discipline. You have to build a business plan for yourself without a doubt, like right down to how am I going to spend my days? I think a lot of people think they can get a job and just go in the office and read reports and be up to speed on what's going on in the markets, and all of that will be enough. And it's really not. I mean, you have to do the networking. You have to go out and make yourself known. I've never gotten a job. I've very rarely gotten an account through anything other than knowing somebody else who helped me. And so the network is really, really important. So if you're just starting out in that business, you have to figure out, how am I going to network? What are the groups I'm going to join or belong to? What are the volunteer activities I'm going to do that will kind of get me in the door with some people that I want to meet? And you have to put yourself out there. And if, some people just aren't, they might be really, really interested in the investment world, but they're introverted. And so you have to reconsider maybe what's your role in the investment business. Maybe you're not a salesy financial advisor who's going to go out and get a ton of business. Maybe you're more of a portfolio manager who works with somebody who does that, and you sit back in the office and trade your stocks and bonds, right? So there are different roles within the industry, and you have to figure out what's best for you and your personality, I think. But creating a business plan is really important. How do you spend your day? How do you occupy your time? You have to realize that it's really not a 9-to-5 job anymore. and I don't think it ever really has been for any successful people. My business life and my personal life tend to meld with each other. I go to a lot of events with friends who are clients, so which is really to me the beauty of the field.
Right on.
So there's not a lot of time to really put it all aside and go home and relax. You're on call, kind of. I give my cell phone out to clients, tell them call me anytime. I don't care what time of day or night. I don't think I've ever gotten a call from a client outside of business hours, except maybe once or twice. But the fact that I gave them my cell phone number was like their way of knowing I'm there for them if they need me.
You're serious.
You have to be willing to do that kind of stuff. And you also have to be willing to constantly learn. And I'm a learner. I've always been a learner, and I'm an information junkie. I read way too many websites, and sometimes, I'm laying in bed at night trying to go to sleep, and I pull up my phone and I'm going on Bloomberg or wherever, because I want to see what's going on in Asia, because it might impact the U.S. Open. So that's just a mentality that I think you need in this business in order to be successful. You don't have to be investment savvy per se, but you need to have someone who is working with you and helping you. That's kind of my advice. Again, the networking is probably the most important thing.
I think, and I've brought it up on other podcasts before, but a common theme that, I've seen from guests coming on the podcast is the reason they're pretty successful is it's not work to them. Like, I think, for example, like you said, it kind of like the personal and professional, it's blended, but I feel like this is for you probably your passion. This is something that you love, that intellectual curiosity. Like you said at night, always reading. I want to be up to date on market stuff going on in the world. It's not work. Like, I think the second you think of it as work, you're dead. You got to have that position where it's like, this is who I am. I love what I do, and I feel like I don't work a day in my life because I'm passionate about it.
I've been a subscriber to the Wall Street Journal since I was in 10th grade. I went into my high school.
Oh, that's amazing. That's amazing.
In the high school library, they had the Wall Street Journal sitting out on the table, and back then there was no pictures in the journal, right? It was just all print and those pixelated drawings of a person's face, maybe, but there was no pictures. So I was like intrigued, like, what is this paper here that has no pictures in it? And I picked it up and I started reading on the what's news side in the left column, and the world was opened up to me. I mean, at that time, this is the early 1980s, there was a lot of, the turmoil then was in South America, not the Middle East like it is today. So in South America, you had wars going on, coups, all kinds of crazy stuff was going on. And in countries I had never heard of. And so my eyes just got opened up to the world. And so I had it sent to my home. I think my mother probably paid for it. I don't remember, because I don't think I had a job back then, but got it every day, and I read it every day. And if they ever take the newspaper part away, it'll kill me, because I love the physical paper in my hand. Yeah. So I was a little nerdy that way, I guess. But that goes to the passion that I mentioned. And is the job stressful? Yes. I mean, when your client has lost 30% of their assets under your watch because, like, the financial crisis happened or something, you do a lot of hand-holding, and it's stressful.
Yeah.
But to know that client stuck with you, trusts you, you've seen them grow, you've seen their family grow, it's just a great,
so fulfilling
experience.
That's so fulfilling. And would you say, too, for your firm culture specifically, I know you just gave some advice to our audience, but I bet a lot of the people probably, under your leadership and working with you, probably exemplify those traits.
Oh, yeah. We have our culture is phenomenal, really. First of all, we are a team, and we're not siloed. Like, if a partner of mine has a client who needs something and he's out of the country on vacation, I'll take care of it, or vice versa if I'm not around. We help each other out. We help each other bring in business. If I have a prospect that's a retirement, so a company that needs a retirement plan, I really am not a retirement plan expert, but I'll bring in one of my partners who is. I'm not afraid to do that. Whereas in a lot of firms, you're on your own. You kind of have to hunt it, kill it, eat it, that kind of thing. We're not that way. So we help each other out, and when we bring somebody new in, we help them be successful. The worst thing for me would be to bring someone into our firm and have them not successful, because to me that's my fault. Either I
Take ownership.
Either I misread what they really wanted, or I didn't do a good enough job to help them through it. So that's our culture. We do the right thing by our clients. We tend to have a lower fee structure than a lot of our competitors, because we do believe that people should have a right to get good financial advice at a reasonable cost. And we've seen too many cases where people are just getting charged too much in this business. It's absurd, actually. Sometimes some of the things we're seeing in terms of we get their statement and we can calculate how much the advisor's charging them.
Yeah.
Because you could see the fees coming out every quarter, and sometimes it's just unbelievable. I think the whole industry's fee structure is coming down, but we just try to do the right thing. We have a smaller group, so it's not, even though we're a big firm, we don't have a lot of overhead, so we can charge a little less, and we certainly want our clients to be successful at the end of the day. So that's kind of our culture.
So for young professionals in your firm, anywhere, maybe like 22, 32, 35, how many people do you think you have young professionals?
I would say in that 22 to 30 age group, we have, let me think, 4 or 5. And the positions range from account administrator, which is somebody who kind of handles transactions for clients. If they call in and say, I need $1,000 deposited in my checking account, they handle that, or I need to make some trades. They might be able to set up the trades. And then a couple of other younger associates are traders, so they will group all the trades together and trade them all at once. A couple are research analysts, so they will help us look at stocks and funds and determine whether or not we want to have them on our platform. Do we want to buy more? Do we want to sell? That's probably the age group that it's the good starting point in this business, because you learn how the business works. Advisors, and some of those people, by the way, are beginning to do portfolio management too. So like if I bring in an account and I don't have the time to actually sit there and manage that account by actually placing trades on my desk, they'll do it for me.
Oh, they're dual skilled. That's great. Yeah,
so
that's helpful.
That's a good way for them to learn how that part of it works.
Yeah.
And then a younger financial advisor, typically there's no age for it, but by the time you're 30 to 35, you're ready to you have enough knowledge under you that you can understand how to go out and start selling the business. And usually in a firm like ours, if we brought in somebody like that now, it would be under the tutelage of one of our senior partners.
Okay.
So we would partner them up, and they would kind of learn the ropes that way until they're ready to be on their own. So I think our youngest advisor right now is probably 40, but that we could go lower than that, certainly. And we don't discriminate by age. It's really a matter of how ready is somebody, kind of like a law firm or an accounting firm. How ready is that person to go out and generate their own business and manage their own book?
And can you tell that the young people you got are pretty motivated? Because what it seems like is, from your firm culture, there's an opportunity for, I'm sure, advancement, other things as well. So they see a path where it's like, I'm not just going to be stuck here. If I really work hard here, I can get to the place I want to be.
I just did our mid-year reviews, and it's the number one question I ask is, where do you want to be in 5 years?
Yep. You got to know.
Or even 3 years. Like, where do you see yourself going? And sometimes you'll get an answer like, I'm really happy doing what I'm doing. And that's fine. Sometimes it's, I want to become a portfolio manager or a financial advisor, or we don't call them financial advisors. We call them wealth advisor or a portfolio advisor. But, if they see that, then my job is to make sure that they're getting ready to make that leap. And if I don't do that, then I'm not doing my job.
2 more questions for you before we close. On a really busy day, describe a day in the life for Jim Iglewski.
I have a lot of meetings. My role as president of the firm is more strategic in nature. So formulating the direction of the firm for the next 3 months, 3 years, is kind of my full-time job. I spend 75% of my time on that sort of stuff. So right now, for example, we are working on a strategic plan for our business. And we have 3 segments in our business: retirement services, wealth management, or what I call maybe private wealth, where, you know, it's individuals and families we're working with, and then institutional business, which is more the nonprofit. And so each of those 3 segments will have their own strategic plans, and we need to go out and figure out how are we going to market our services in those areas, who are we going to hire to fulfill roles in those different things. So right now, I'm spending a lot of time on that. And I'd say the other 25% is maybe your more typical managerial kind of roles where there's an issue that comes up today, this morning. Like we had one last night. We had a client, a business client, retirement client, who was having issues with a bank account. And they were concerned that there was fraud happening on their bank account. And this is a 5-star bank customer. So they asked us to look into it with the bank, and we did this morning and found out there was no fraud going on. It was a setting in their computer system which was causing the issue.
Yeah.
So those kind of things come up. I wouldn't say every day, but, you know, during the week a number of times, and so I involve myself in that kind of thing. Mm-hmm. And then I have pockets of time where I really don't have anything going on, and that's where I use my time to try to catch up on the markets, do some research. I do a lot of that on my own time. Mm-hmm. Saturday mornings, my wife is ready to kill me because I'm usually in front of my computer catching up on research from the week.
Yeah.
That I didn't have a chance to get to.
Yeah.
So.
And well, do you golf too, by any chance?
Not very well.
'Cause I was going to say, if your wife hates you for Saturday morning doing that, playing golf too, that might be tough.
No, I play, but I play somewhat rarely.
Yeah.
Only because I'm not that good, but that's not really why. It's more the time constraints. So if I play, it's going to be on a Sunday evening, typically. Mm-hmm.
Sure. And last question for you. You probably mentioned, well, you said a good amount about, you know, your firm culture, getting everybody together, and really what it takes to succeed. What would you say, though, for being president of the firm, your definition of leadership? What does leadership look like to you?
Leadership is serving others, and you know that in any capacity, I think you're giving of yourself for the benefit of others. I've read a lot of leadership books. I've read biographies of leaders like George Washington. You know, why was George Washington successful? He lost more battles than he won, but he happened to win some of the biggest ones that, you know, mattered. His soldiers loved him. I mean, literally loved him and would do anything for him. And that's because he cared about them. And they knew if they were being sent into battle that it was a worthy cause, and it was well thought out, and it wasn't taken lightly to put them in that situation. So I think leadership is gaining that trust from the people you're leading, that you have their best interests in mind, you know what you're doing, and that you're decisive. And to me, that's being a leader. It's service to others and helping them be the best they can be.
I love it. Where can people, if anyone has interest, find you? Your website, LinkedIn?
Yeah, I'm on, my contact info is on the website. My email, I think our general phone number's on there as well. You can reach out to me that way, and you know, I'm happy to give my cell phone out if you reach out to me, and we can have a chat, and I'm happy to meet with anybody. I do this a lot with students. Just had an intern over the summertime who did a great job for us, going back to St. Bonaventure. And I just met with a high school senior who's going off to college, who knows he wants to be in this business. And so I want to keep his name, you know, front and center. So gave him my cell. I said, hey, anytime you're up, you know, you're up back in town during Christmas or what have you, let's get together and have lunch. So I'm always happy to do that.
That's great. Jim, this was awesome. Thanks so much for coming on.
Thank you, Nick. I appreciate it.
This was great. Awesome. Take care, guys.